Have to go back. Okay, we're live.
Welcome back,
Right?
everyone. Apologies on the little technological hitch we had, but we will go back as though nothing happened because that's what we do,
Right.
right?
We'll
So
start
let's
off
go
where we
back.
left off.
Absolutely. Let's talk about how we have the control in appreciating the value of the apartment. So I was talking about how apartments are considered a commercial real estate class, and as with any commercial real estate asset, the value of that asset is dependent on the net operating income that it generates. So if you take, for example, two apartment complexes that are right next to each other, so market is no longer a player, so they're both exactly in the same market. But one complex would be generating more income. In that case, that complex is actually valued at a much, much higher value than the other complex. So, what does that tell us? That tells us if we can figure out a way to increase the net operating income, then we can actually increase the value of that apartment. So, what is considered net operating income? This is actually our sixth grade math formula. Net operating income is nothing but your net revenue minus your total costs. So, your total revenue minus total cost is your net operating income. There are only three ways that you could actually increase the net operating income. You either increase your revenue, or you decrease your costs, or you do both, right? That is as simple as that. This is not like a secret sauce. This is not something we invented. This has been around for a long, long time tested and proven, right? So, how do we increase revenue? We're going to talk about that. How do we decrease costs? We're going to talk about that. How do we do them both at the same time? We're going to talk about that in just a second. In addition to being apartments being low risk and also having giving us control to appreciate in value, there are several tax advantages. And again, I'm not a tax expert, but I would advise anyone who's listening to this, if you have never talked about taxes with a tax consultant, now is the time for you guys to get someone engaged, someone who's an expert engaged, and help you guide through this. So there's a few things that I want to highlight. One of the ones is the 1031 exchange. The 1031 exchange basically means if you've invested in any real estate class, that's considered commercial, not your own residential purposes, but for a commercial purpose, and if you've made profits on it, then if you reinvest the profits within a certain period of time, then you can defer the taxes to a future date, and you can just keep deferring it forever. So that's a beautiful, tax provision that is out there that you should take advantage of. In addition to that, you also have the ability to depreciate buildings, any of the commercial assets over a period of time. In our model, because we are in and out of a asset within 5 years, we use what is called as a uh, accelerated depreciation, which depreciates the value within 1 to 5 years time frame based on how we wanted to do it. Also, we get to write off all the capital expenses, like all the improvements, the capital improvements that we make on those apartments, we get to write off those expenses. All of these various tax advantages translate into more money into your pocket that you can take and actually continue to grow your portfolio, which is a beautiful thing. Right. So these are the top three reasons. I mean, we have other reasons as well, but these are the top three reasons why we find apartments extremely attractive and lucrative to invest in. So people also ask me, like, when do you know, and how do you know that this is the right time to buy, right? So I always tell, real estate is again another commodity, right? It's like gold, it's like, oranges, it's like any commodity that trades in the market, right? It has its ups, it has its downs, it has its ups, it has its downs. So it also still follows the buy low, sell high, simple concept, right? So, but within real estate, there's this particular four things, 4 points of this market cycle that you need to pay attention to. This is what I call the buyer's market one, or an amateur buyer's market. What it means is this particular buyer has seen that historically there was a higher value for that asset. It dropped in value. They felt, hey, you know what? It used to be $1 million. Now it is only 700,000. So, it's a good time to get in because I'm getting a $300,000 discount. That's what this buyer's thought process is, right? But what this buyer doesn't know that there are other factors that are in play over here besides the cost, that they're not taking into consideration. And this buyer doesn't know that there is further potential for this value to go down, and then it would take him or her a very long time before it actually gets back up to that $1 million value. So that's why this is called as buyer's market one, or a premature buyer's market, or an amateur buyer's market. So they have based the decision just based on one factor. Typically, this cycle is an 8 to 10 year cycle. Some markets, perform better. They have longer cycle times. Some are very short because they don't have strong economic drivers. But a typical market is 8 to 10 years. So for this buyer to get back up, they have to wait that entire cycle before they could come back to that value. So we obviously don't want to get in the market here, right? So we want to wait until this buyer's market two hits, and that's when we try to focus on those markets. So how do we know that it is a buyer's market two, right? That's a $1 million question, right? So there's very very open, and this is not any secret information. There's actually all of this information is out in the market. It's free for anybody who subscribes to any of the real estate reports. Whether it's CBRE, Marcus Millichap, they all have their real estate reports. You can also go to census reports, because that tells us the population influx in and out of a city or a metropolis. So there is a lot of indicators out there that tell us that a certain market is right now experiencing a buyer's market too. And at any given time within the United States, or for that matter within the world, there's metropolises always experiencing the buyer's market too. So all you need to know is what indicators to look at. So just for an example, a strong indicator of a buyer's market too is when you have had a long recession, like maybe after 8 or 10 years, the market rents are now starting to go up. Starbucks is thinking about opening a whole bunch of locations over there. Or it could just be that there's a huge population coming in because some big, market giant decided to open their warehouses over there. So there are indicators that basically are telling us that there's going to be new jobs, there's going to be new people moving into that area, so there's a demand for the apartments. That is as simple as, you can break it down. If you can read that information and come to those simple conclusions, then you know that that particular market is experiencing buyer's market too. And that's when that's what we do. And we start focusing on those markets once those strong indicators are showing up. And then that means we try to start getting into that market and somewhere around here, and we ride this wave and get out over here. Again, similar to buyer's market one, seller's market one is also an amateur seller's market, meaning this particular seller saw an historical low price and they got in around that period and they said, you know what? I made my money, so let me get out of here, without knowing that this market still has potential to ride up, and they're basically getting out of the market prematurely. They're still profitable, they're just not maximizing, they're leaving money on the table, right? So we try to get in somewhere over here and get out around the seller's market two area. And we obviously are not going to wait for the peak market, because when we try to put the asset out for sale, for whoever is purchasing, we want that asset to still be attractive enough to buy. We want to leave enough meat on so that it's attractive for them to purchase, right? So we do typically get out around seller's market too, where the market has already risen to its maximum potential. And then, we try to get out of the market over here. And then maybe 10 or 15 years down the lane, this market again would experience buyer's market 2, and then we would start looking at it again. But until then, we take our money and we go to a different market that's experiencing buyer's market 2 and invest over there. So that's really the simple thought as to when to buy. Again, then comes where to buy, right? Once you decide when to buy, all you need to do is identify the markets that are experiencing that buyer's market too, and then we focus on that, right? So as of the second quarter of 2020 reports that we have reviewed, we have noticed that certain markets are what we are targeting: Charlotte, North Carolina; Charleston, South Carolina; Gainesville, Florida; Athens, Georgia; San Antonio, Texas. Again, these reports are current as of Q2 2020. And another little secret about, open secret about where we invest, we don't really invest in the primary and the secondary, not in the primary markets, but we invest in the secondary and tertiary markets. So I'm just going to use an example, right? Like, we have Atlanta metropolis that is amazing right now and it's booming. But if you go into the core Atlanta, you would experience that there's a lot of competition that's driving the price up. And, it's just, not worth our time to, be in that competitive market. But there are markets around the Atlanta area that are also experiencing boom because of what we call as spillage effect, right? So those markets are now, open. They don't have a lot of competition, so we can get in there. We can still experience the same boom because of the vicinity and the spillage effect that Atlanta is giving us, and still make our money, right? So that's why we focus on the secondary and the tertiary markets, and that strategy really paid out very well for us. So our base criteria obviously is an MSA population of 250,000 or more, and then a crime index of less than 500, and that market should have at least one interstate connectivity and must have an airport. So that's our base criteria. In addition to the base criteria, excuse me, we also have growth metrics where we want to have a 10 plus year over year consecutive growth, and a growth of population of at least 2% or more, job growth of 2% or more, household income growth of 2% or more, and property value growth of 5% or more. So these are the metrics that we look at, before we decide, okay, this is the metropolis that we need to focus on, and let's go after the secondary and tertiary markets that are, associated with that metropolis. So that's, as to where do we buy. Then what to buy? So this is another question, people ask, like, hey, do you guys buy high rises? Do you guys buy garden apartments? Do you guys, what are your criteria, right? So I tell them, we don't really care about the type of apartments per se. What we care about is what those apartments are relative to the neighborhoods that they're present in. So what does that mean, right? So apartments and neighborhoods are classified as class A, B, C, and D. What does it mean, right? So if an apartment has been built in the last 10 years or has been renovated to match any of the new construction, then it's considered class A. And similarly for class B, 10 to 25 years ago, they were brand new, or they have been renovated to match the brand new at the time 10 to 25 years ago, then it's a class B. Similarly for class C, it's 25 to 40 years, and class D is greater than 40 years. Similarly, neighborhoods as well, are class A, B, C, and D. Class A is basically a happening neighborhood, it's booming right now. In the past 10 years, it's been booming, so that's a class A neighborhood. Class B used to be the place, 10 to 25 years ago. Class C is a more mature neighborhood, like 25 to 40 years ago, and Class D is beyond 40 years. I think the map basically shows us looking at Class C apartments in a Class A neighborhood, that will allow us a huge margin. If we can bump up even by one class, we're pretty much doubling our money, right? Our Class B apartments in a Class A neighborhood, and even Class A apartments in a Class A neighborhood, they're great cash value, cash flow, cash cows, so we do focus on these. We also focus on Class C apartments in Class B neighborhood and Class B apartments in the Class B neighborhood. Obviously, we don't want to purchase newer apartments in an older neighborhood. So this is pretty much our focus. Occasionally we find some gems that are Class C and Class C, but they're so rare. That's why this checkbox is it's a little bit of a maybe, because those are kind of hard to find and still be profitable for us. But these definitely, if they fit this criteria, we would look at them and then we would run them through our program to see if they're profitable. We did build like a little bit of mathematical model for ourselves to see if it's profitable. So once certain criteria is met, we take them, we crunch the numbers, and we make a decision whether it's worth moving forward to present a letter of intent on that asset. But this is pretty much as to what to buy. Again, no secret sauce. This is very intuitive, logical, and a no-brainer, analysis. Also, in addition to that, we also look at, from an economics of scale perspective, we buy 150 or more apartments so that we can afford a full-time on-site property manager and maintenance person. I mean, you would still need them even if it's a smaller property, but having 150 or more makes it, economically viable solution to have them. And also, buying the right unit mix. A typical tenant base that we are looking at is a young professional or a young couple who are professionals. So they usually look for like 1 bedroom, 2 bedroom apartments. So the more of those units we have in the complex, and the ratio of 1 to 2 respectively, is actually considered a right unit mix. Again, this is market data telling us that. So why change it? If it's working, we are going to use that, right? And then obviously the unit size also matters. We try to have slightly larger units because again, goes back to the tenant base that we are targeting, right? Like the young professionals, the young couples, and young families with kids. We want to make sure that we have those larger square footage because that's what they're demanding. And we try to avoid studios. Studies have shown that studios are considered high risk from a fire perspective because your stove and the bed are in the same location, and studies show that beds are the ones that catch fire fast and they spread fire faster too. So we try to avoid complexes that have a lot of studios. I mean, there's going to be always like 1 or 2 studios, and that's fine with us. But if there's too many of them, we try to avoid that as well. So this is basically from a unit size and a unit mix perspective. How do we evaluate, whether to move forward or not? Obviously, so we have learned a few things now. We let the market help us. Remember that little sine curve that we talked about: buyer's market 1, buyer's market 2, seller's market 1, seller's market 2. The market is helping us. We also add value to the asset. So how do we add value? So it's like a 75% value play and a 25% market momentum play. So in the value play, remember I talked about increasing the net operating income, which basically is increased revenue and decreased expenses. Obvious increase in revenue for an apartment is obviously increasing rents and increasing the occupancy of the complex. Then, decreasing expenses. When we buy some of these complexes, they usually have some issues to them. They may have a perception problem. They may have just bad tenants, non-paying tenants. They may have, an out of town owner, basically, who's not focusing on the management. So they've hired a property management company that probably doesn't care about giving returns. Their job is to maintain the property. They don't care about giving great returns to the owner. So there could be lots and lots of issues. So we go in, we identify what those issues are. We address those issues so that the expenses that are associated, the loss of income that's associated with those issues are being addressed, hence decreasing our expenses. And then we also add additional income sources. So sometimes when we purchase some apartments, these are like 30 years old apartments, at the time, it was not, a trend to have a laundry facility on site. So, there's no laundry facility on site. The tenants are actually going to a coin laundry nearby and doing their laundry. So just by adding a laundry facility on site adds a lot of value. Because it doesn't cost us anything. We just have to work with the company. They drop their machines. All we need to do is give them a location where they can put those. They create those coin operated or the credit card operated, machines, and we get a share in that income. We also have strategically placed vending machines here and there. So if any of the folks that have a sweet tooth, I'm one of them, in the middle of the night, they don't really have to go to a store, to get a piece of candy. There's a vending machine out there. They go and get it from there. So we work with the company. They come in, they leave the vending machines. We just show them where they can have those vending machines. They stock them, they do the accounting, and we just get a profit share for allowing them to use our site, right? In addition, we also have pet fees. We make our complexes pet friendly by creating a dog park, and charge a little bit more. With more and more people, with technology, more people are lonely and they want a pet, right? So by making our complex pet friendly, we are able to charge them that pet fees. Also, if you see, if you've ever lived in an apartment, you would know some apartments advertise, hey, water is included in rent, gas is included, electric is included. The reason behind that is when they built the apartments, they didn't really design to have a separate meter for everyone, which is why they're absorbing the cost, right? All we need to do is work with the city and work with the appropriate department, and they would come in and they would install those meters. They cost about like $30 per unit, which is a very good investment. You put that in, and the following month onwards, the cost now goes back to the tenants. So there's lots and lots of different ways. Again, these are just a few. It's nearly impossible to list them all. But there are various of increasing income. And we also add value definitely by doing interior renovations. Obviously, if you have a choice between renting a place for $500 worth of renting a nicer place for $550, you wouldn't obviously mind spending those extra 50 to have a nicer place, right? So when we add those interior renovations, add amenities like pool or a gated community or a clubhouse or a gym, there's a whole lot of amenities that you could add. When you do those, it makes that complex more and more attractive for a quality tenant to move in, thus giving us the ability to increase the rents and thus increasing the net revenue, thus increasing the net operating income, thus increasing the value of that complex. So that's basically, in a nutshell, how do we take maximum control of that value play and increase our net operating income. In addition to that, if you remember my little sine curve, we do believe in buying in the right market. We don't have to buy a complex right next door to our home. We can buy a complex anywhere in the United States that's experiencing that buyer's market too, and let the market help us push the value. So we acquire apartments in those emerging markets. We make sure we're buying in the right market cycle, right? Like, between the buyer's market two and seller's market one. And then if the market is moving fast, we trade up. Say we own 150 units, and that market is moving very fast. We make our money on that 150, we sell it, and then go get a 300 unit, right? Because we want to maximize when it's in that upward movement in that sine curve. We want to trade, we want to own as many assets as possible and ride that wave as quickly as possible, and then maximize our returns. Also, in those fast moving markets, what we do is we create a larger portfolio of cash flowing assets so that when we are ready to sell, we sell it to like a hedge fund or REIT who don't care about doing any of the work. They want a turnkey property that's generating X percentage of money on their investments. If you can create a cash flowing asset that's anywhere from 12% return, they would be happy to take it off of your hands. There is no going for a loan. It's really easy and hassle-free. It's actually almost counterintuitive that when you sell a large amount, you actually get a better price. When in all conventional wisdom tells us if you sell a large amount, you have to give huge discount. That's not at all what happens when you are working in those large emerging markets and create that large portfolio, because it's easier to sell because you're selling it to big players, players who have access to a ton of money. They just want to get in and start making their money. So that's letting the momentum play. So that's really, so if you see, we are only relying on the market 25% of the time, but 75% of the time it's totally in our control. So if you are a disciplined investor, if you have the knack to identify the right market and you figure out a way to maximize the value, you're going to be golden in this. This is a no-brainer. There's no secret sauce. There's, if someone tells, hey, I invented this because of which I'm hugely successful, well, they're lying. So this is really how to buy strategies. So if I have to, sort of put it in a three-step process, when we look at, a certain investment, our philosophy is very simple. Does this asset have significant value addition, right? That whole thing about increasing rents, decreasing expenses. Does it have enough problems that we can solve and by solving add value? That's basically the first question we ask. Does it have a cash flow potential, right? Obviously, we want to be able to rent it out where we can increase the occupancy and keep it at 100% if possible and have a steady cash flow, right? So that's the question we ask. And then, can we increase the portfolio, right? Like, I don't want to just own one complex in the market. I want to be able to own 10 complexes in the market in the right time so that I can, when I have to sell, I sell it as a big, large portfolio. Is there potential for the increased portfolio growth? So these are really the three criteria in a nutshell, right? So when I was, talking to Tony about coming and hosting this, Tony said, I need you to give them three pieces of advice, right? Here it is. When you look at an asset, you need to really think, is this going to add a lot of value, right? Can I add value to this and increase in value?
Right.
Can I create a cash flow potential? And can I do this, not just one complex, two complex, can I do this in a larger portfolio so that in that 5 to 7 years of growth that you're experiencing, can I maximize and, take the full advantage of the market? And then when I leave, I would have no regrets, right? That's really the three steps that we look at. So that's all I have. So I would like to open the floor now for any questions. Milt, do you have any questions that are,
No, I don't. That was a very, very well presented uh, take on the commercial real estate market, and I think a lot of those numbers and everything kind of speak for themselves, and I think a lot of people can see that. Tony?
Yes. Well, Nalini, I want to thank you because it was very educational, and I'm sure that we're going to have people more interested because you took the scariness out of commercial real estate realm. But I have some questions, so maybe
Go
you and I
ahead.
can exchange on some things. So to the extent that I'll go back earlier in your discussions about identifying markets, you mentioned some of the resources. Now, my background, I was an intelligence officer, so doing research and gathering information is one part of the process. How do you and your group go about the distilling of that to say what markets to target and which ones to avoid? What
Absolutely.
is internal process, if you can
So
share?
if you see, most of the partners, we all actually are from the East Coast. So we do primarily focus, geographically. It just makes sense so that we are not on a weekly red eye flights. We're not flipping properties in Hawaii. We're not flipping properties in, uh, California, right? So we did logically did choose the East Coast and primarily, Southwest and Southeast areas that are closer to our geographical comfort. Apart from that, obviously we do subscribe, at any given time, we do actually watch about 30 different markets, to see, hey, where is this market cycle at, right? So once you sort of identify where in the market cycle is, everything that goes up must come down, everything that's going down must go up. That's really after that, once you've identified that, you just need to focus. And then as the minute that buyer's market two is hit, we focus on those markets a little bit more. With regards to where do we get that information, right? We do subscribe to a lot of real estate, literature that's out there, and it's free. Anybody can go, and you can go to CBRE and you can subscribe to their newsletters. You can go to Marcus Millichap, the Cushman Wakefield. There's also you can sign up with the census, various census resources. Again, this is to understand the population influx. There's always Wall Street Journal that talks about the major financial drivers. It's specific to different industries. That's also important. Like for example, when the 2008 meltdown happened, right? Again, this is a hindsight wisdom that I'm sharing. That if you were watching and if you were in the market at the time, you would know. One of the biggest things that happened was, there was a huge financial meltdown, right? People were losing their homes, banks were not getting paid mortgages, banks were going bankrupt, right? That's when we had that huge bailout that happened, the financial bailout. But as part of the financial bailout, if you remember, one of the things that came out was a heavy regulation on banks. So they have to report constantly about their ability to stay liquid, to stay in business, if in case another financial meltdown happened. If you think about it comparatively to back in 2008 and currently with what's happening with COVID-19, I think the fact that banks are able to give forbearance to homeowners, that are struggling with a loss of a job, all of those things are a result, direct outcome of measures that were put in place during the meltdown that happened last time, right? But if you were not paying attention to it, you wouldn't know where to start with it, right? So that's information that is actually open for public. Now you take that information, right? So when this COVID happened and we were looking at all these measures where, we were told like, hey, don't put pressure on your tenants to make a payment, you can't evict them. We didn't even flinch because we knew that there's measures that were put in place. We were able to take advantage of some of the, benefits that the government offered for owners that are impacted, business owners that are impacted. So it's just about knowing what's happening in the market, and we do spend significant amount reading the literature and taking that information and interpreting it also, right? Like among the partners too, we have regular discussions, right? Hey, have you read this article, right? This is what is happening right now, right? We do spend that time in learning our business. And again, this is a continuous process, right? There's always something new that's happening. I mean, none of us have thought about COVID. This is a lifetime event, right?
Exactly.
Who would have thought that we would all be confined in our homes for months and months and months, right? So, yeah, so it's just keeping an awareness of what's happening in the market, and it's always good to know your business.
Right. Well, thank you for
that.
that.
What your show says, mind your business.
That's right. Exactly. Right on time and right on target. Now, I do want to say this as we're reaching the end of the show that, I met Nalini, and we're in the early stages of working for the private money syndicate to help capitalize their continued growth. They have some very ambitious goals. And because time is running so short, Nalini, I might have to have you back on to talk about, some of the other things that I would like to talk to you about on camera. But we have a hard deadline that we have to be to be off the air by noon.
It would be my pleasure, Tony.
Well, certainly, and you're such a delightful person, and you did a great job, by the way. So we really want to thank you on behalf of our viewers. And so for all of you out there, what we're here in the Buying Your Business show is to help you to learn how to grow whatever it is that your pursuits are, be they business or real estate. And certainly from the standpoint, the commercial real estate, the multifamily dimension is one of the most profitable, historically, one of the best ways to grow wealth. And we've had a perfect example or great presentation by way of example of someone who has participated. They did certain things. One, Nalini's not doing it alone. She has a team. The second thing is that they do their homework, resources that are readily available, and they have a plan. They have a process. They have a discipline, and discipline is important for you to be successful, whether it's in business, single family, or commercial real estate. So as we have about run out of time, I want to thank each and every one of you for being with us today. And as we always say, you can reach us by getting in contact with us through the privatemoneysyndicate.com. You can go to the scheduler to schedule a one-on-one meeting. And we will have Nalini's information posted on our website, as well as we'll have it posted on Facebook Live. And as we say to you every week, I really appreciate you. And if you're going to go into business and stay in business, you have to mind your business. And with that, I want to turn it over to the maestro. Thank you so much for helping us to overcome a technical challenge and for having us hosted this morning. So with that, I'll turn it over to the maestro.
Thank you. And I just want to say thanks everybody for listening, and tune in next week for some more valuable information. Take care, and we'll see you on the next one.